Hey everyone, and welcome. Today we are going on a journey. We're going to follow the money, tracing the path of a single dollar from a customer's bill all the way to a company's core financial records. We'll pull back the curtain on how massive companies use a system called SAP FI CA to bring perfect order to millions of transactions. So just picture a huge telecom company. We're talking millions of customers, which means millions of invoices going out every single month. How in the world do they make sure that every dollar, every cent is accounted for perfectly? How does it all balance out without a single error? Well, that is the exact puzzle we're going to solve today. You know, the key to unlocking this whole thing is realizing that every single transaction actually tells two different stories at the same time. There's the story the customer sees, and then there's the completely different story that the company's accounting books see. They're connected, for sure, but they are not the same thing. And these two stories are told through two key documents. First up, the invoicing document. This is your bill, the thing you get in your email or your mailbox. It's designed to be simple and clear for you to understand. But behind the scenes, the moment that's created, the system generates something called a posting document. Think of this as the internal, secret language of accounting. It details exactly how that transaction hits the company's bottom line. So let's trace the high-level path, right? Step 1, an invoicing document is created for the customer. Instantly, the system generates that corresponding posting document for the accountants. This document then creates entries in a special subledger called contract accounts, or FICA for short. And finally, all these entries in FICA get bundled up, summarized, and officially posted to the company's main book of records, the general ledger. Okay, I know that can sound a little abstract, so to make this crystal clear, we're going to follow one simple, everyday invoice through this entire journey, step by step. Let's make it real. All right, here's our invoice, a nice, clean $100. It's broken down into $70 for voice services and $30 for data services. Now, this is the invoicing document view. It's exactly what the customer sees. Pretty straightforward, right? But here is the million-dollar question. When that $100 payment arrives, how does the system know not to just dump it into one giant revenue bucket? How does it intelligently split it, making sure the voice department gets credit for its $70 and the data department gets credit for its $30? The answer is actually really elegant, and it's incredibly powerful. The system doesn't see words like voice charges. It sees codes, a special two-part code that basically acts like a GPS for every single dollar. The first part of that code is called the main transaction. The easiest way to think about this is as the general category. It tells the system the big picture. Are we dealing with an invoice, a payment, maybe a refund? It's the what of the transaction. Now, the second part is the sub-transaction, and this is where the real magic happens. So within that invoice main transaction, the sub-transaction gives us the critical detail. Is this invoice for voice revenue? Is it for data revenue? Or maybe it's a late fee? This code specifies the financial event with surgical precision. Okay, let's look at our invoice again, but this time we're going to look at it through the system's eyes, at the posting document. See? The system creates 3 lines here. The main transaction code is 001 for invoice on all of them, but look at the sub-transactions. It posts a $100 debit to accounts receivable, but then it credits 2 different revenue accounts, $70 with sub-transaction 0010 for voice and $30 with 0020 for data. Just like that, the money is perfectly sorted. So we know these codes are the secret sauce. But how can a real person, like an auditor or an analyst, use these codes to trace the money? All right, let's put on our detective hats. The entire system, the whole thing, hinges on one process called account determination. You should think of this as the master rulebook for the company's finances. It's a huge set of instructions that says, hey system, when you see this specific combination of main and sub-transaction codes, you must post that money to this exact general ledger account. It is the unbreakable bridge between those FICA details and the main financial books. So how do you actually follow that path? Well, if you were an analyst, you'd start by pulling up any FICA document and finding those main and sub-transaction codes. Then, you dive into the system's configuration to check the account determination rules. Specifically, you'd look in a key setting. In SAP, it's often called Posting Area 2610. And right there, you'll find the exact mapping that links those codes to a specific GL account number. And for anyone who actually works in SAP, you know the whole system runs on these things called transaction codes. They're basically command shortcuts to get things done. You'd use a code like FBO3 to pop open the document itself, and another one like FKKAC to view that all-important account determination setup. With just these two tools, you can trace any transaction from start to finish.
And here it is, the final destination. This is the payoff. You can see the codes from the posting document on the left are perfectly automatically mapped to specific general ledger accounts on the right. Code 0001 goes to GL account 11,000 for accounts receivable. 0010 maps to 4,000 for voice revenue, and 0020 maps to 4,100 for data revenue. Every single dollar from our original invoice now has a precise, permanent, and auditable home.
You know, there's a really great way to sum all of this up. This structured process is the backbone of financial integrity in a high-volume business. It's not just about bean counting. It's really about trust and stability. We've gone pretty deep into the how, but this brings us to the most important question of all. So what? Why does this journey even matter? Why would a company build such a detailed rule-based system?
Well, it all boils down to three huge benefits. First, financial accuracy. This process guarantees that revenue from different parts of the business never gets mixed up. Second, auditability. This is huge. An auditor can pick any number on a final financial statement and trace it all the way back to a single customer's invoice. And finally, automated reconciliation. Because the rules are so strict, the system can balance billions of dollars in transactions all by itself, without a human ever needing to touch it.
What this process really does, when you think about it, is take what could be absolute, total chaos, millions of separate transactions flying around, and it transforms it into perfect, reliable financial order. This system is an absolute marvel for tracking everything that goes right. But that leads to one last thought. What happens when things go wrong? How does this same bulletproof logic handle things like customer disputes, returns, or collections? Well, that sounds like a journey for another explainer.